to anyone,
Good
While I am
afternoon.
to anyone who is a
I
part
am
getting
of
my
Selah.
screen in
our
place.
of this series. So S corps. So for those of you who either have one or are thinking of like, what is this about? I want to go a little deeper than I went last time on the S corp election. So you've got different ways that people can get your company set up. Some people just might be what we call a sole proprietorship. You just have a DBA, doing business as, we call it a fictitious name or an assumed name, and you're doing business and you're considered a sole proprietor at that point. You may have an LLC. You might have gotten an LLC set up and you're maybe a single member LLC. It's just you. The IRS calls that a disregarded entity for tax purposes. I'll tell you a little bit more about what that means here soon. You might have a partnership. You might have other owners in your LLC. You might have an S corporation election. You might have elected for your S corporation to be taxed as from your LLC to be taxed as an S corp. You might actually have a corp. So a lot of things, and there's so many different types of businesses. Those are just a few of the key ones. But why would you want to become an S corp? Well, here's the reason. I'm going to walk you through better understanding this whole S corp piece. When you're a sole proprietor or a single member LLC and you make, say, $100,000, okay, net profit of 100 grand, you're going to pay this 15% self-employment tax. So that's 15.3%, which is on the slide. That is a tax, which is really Social Security and Medicare. So the 15.3%, all it is social 7.65% times 2, which is 15.3. Normally, if you're a W-2 employee with a job, and some of you are, maybe you have a W-2 and you have your business, well, you see on your check and on your W-2, Social Security and Medicare taken out. As a self-employed person, you pay the whole amount. You see, as an employee, you pay half, the employer pays half. You only see the half on your check or your W-2. You may or may not know that. But as a self-employed person, you pay the whole amount. So that's where that 15.3 is coming in. So part of the problem with that is when you're a small business owner, say, for example, you've got contractors. Say, for example, you have W-2 employees. So for example, you have others who are laboring to produce part of that net profit that you have at the end of the year, that $100,000. Maybe you're responsible for 50% of it. Maybe you're responsible for 50,000 of that net profit, but others are responsible for the other 50,000. Problem is, you're still paying self-employment tax as if you were laboring for that full 100,000. So that's a problem because then you're paying double the self-employment tax. So what do we want to do? We want to avoid paying double that self-employment tax. And this is just one aspect of it. There are many aspects of it. So for you, what do? Well, one option would be to elect to be taxed as an S corporation. What happens then? When you're taxed as an S corporation, you then become an employee of the company. You get a W-2. So you don't get a W-2 when you're a sole proprietor. You don't get a W-2 when you're the owner of an LLC, whether it's single or multi-member. And so that then triggers a W-2. What does a W-2 do? The W-2 collects Social Security and Medicare, just like as if you were an employee, you become an employee of your company. And what happens to all the other net profit that others are laboring for? Well, how does that then get taxed? Am I still taxed the 15.3% self-employment tax on that? And the answer is no. As long as you take a reasonable salary, we've got an entire system where we look at the Bureau of Labor statistics and we analyze based on your proficiency level, the kind of work you do, how much you should be paid for your labor. And that's your reasonable compensation for your S Corp election. So we say we take that same $100,000, just like in this example here. Now you are only laboring for half of it. Okay, so you take the other half, which is what, 15.3% on $50,000. And how much is that savings? Roughly about $7,500. So there's $7,500 that you're not now paying on self-employment tax. So you just saved yourself $7,500 in tax. That's on that same 100,000. If that's the case, maybe it's 200,000, maybe it's 3, maybe it's 4. As you can imagine, as your income increases for the company net profit, then you will pay less. Now, there's a cap on Social Security. There's no not on Medicare, but there's a cap on Social Security. And so once it hits that cap, then that 6.2% times two, which is 12.4%, goes away. Nonetheless, it's a great tax strategy from that perspective. A lot of the problem is that a lot of accountants will set up their clients with the S corp, but the business owners don't really know how to maximize its effectiveness. So this is just one small strategy, which has a big payout for you as a possible S corp election. You say, well, then Nate, how do I access that other $50,000 that I didn't have to pay self-employment tax and that's not running through my W-2? Well, that becomes equity that you're building in the company. So that's your own equity. That's your own cash that's building up. If you imagine it's just your bank account, if you will, it's a business bank account. And on the balance sheet, it's called retained earnings. So that's earnings that are retained by the company. Very simple. So at some point, you can distribute those retained earnings. You can return them to you as a return of your equity. Do you pay tax at the time? This is a question I get often. And no, you don't pay tax when you take a distribution because the distribution's not taxed unless it's above and beyond your what we call your basis, which is an advanced conversation we're going to have when we do our advanced tax strategy combo. You pay tax on the net profit. So you've already paid tax on the net profit because that was your $100,000. You pay federal and state tax and sometimes local. And so you just are avoiding that self-employment tax on the part that you are not responsible for laboring for. So hopefully this gives you a little bit of a deeper understanding of this idea of the self-employment when it comes to S corp elections. Does anyone have a question or a comment on the S corp election regarding the taxes and the tax savings? I know there's a lot to talk about. We could actually have a seminar that's just a whole day on this particular topic. But I want to give you just an opportunity, a quick opportunity, if anyone wants to ask me a question about the S corp election and how it relates to taxes. And if there are, if there are no questions, that's perfectly fine. We can just keep moving on. So this is a conversation that you want to have with your accountant. You want to, even if you are an S corp, then you want to ask the question, hey, am I maximizing the value of my S corp election? What else can I do? Because this is one piece of the conversation. There's all kinds of other aspects of the S corp election that are also beneficial to you. And so if you're not an S corp, ask your accountant, your tax accountant, to perform an analysis. When would it be a good time for me to become taxed as an S corp based on my individual circumstances? And if they can't answer that, I would recommend that you have a conversation with an accountant who is well versed in the S corp elections and also that does tax planning. Okay, and so whether it's us or anyone else who does this, we want you to do that because this is such a powerful tool for you if it makes sense at the time. A lot of folks, maybe it doesn't make sense. We don't always recommend this because it may not be time to do this particular strategy. All right, next. All right. Now, a lot of people think about the home office deduction, and I want to talk a little bit about that because everybody knows about, hey, oh, I know I can deduct maybe my internet or part of my vehicle and things like that. We'll go a little deeper into some other expenses later in on this conversation. But I do want to talk a little bit about what we call the accountable plan, or essentially getting reimbursed for your home office deduction. So if you have an office at home that's used exclusively for business. A lot of people today, they might have an office or they might sit on the sofa these days and do their work at the kitchen table. What we want to do is we want to designate where that is. And then we want to get a percentage of the square footage from that to that area to the area of your total square footage, your home. Now, there's a whole calculation for that. The important thing is keep this on your radar. There's deductions. It could be for your phone, for your internet, and then there's other things too for maintenance and repairs on the home to the extent that it affects that area. Also, any other expenses that you're incurring on your home. So you want to keep track of all of those home expenses for the year, maybe there was an improvement that involved that office. Maybe, we've got clients who, hey, I'm going to upgrade my home office. I'm going to buy furniture for my home office. There's actually furniture that I'm using in my home office that I never expense the company. Well, now's a great time, especially toward the end of the year, to take an inventory. Take an inventory of everything that you're using or everything in your office, if you have an in-home office, that is utilized for the business exclusively 100%. If it's not, then you can do a percentage of that. And then what we want to do is we want to expense it to the business or sell the item to the business. Okay. So what does that mean? Boy, I bought this desk 4 years ago and I bought it personally, but I'm using it for my business. Well, what's the fair market value of that today? Because if your business is using it exclusively, then we need to make sure the business is writing that off as an expense. And we can do that. We can sell that to the business this year. And you say, well, Nate, won't I pay taxes on it if I'm selling it to the business? Well, if you paid at least that amount for it, then it's likely that you will have zero tax liability. Again, this is a conversation with an accountant. But you'd be surprised when we have these conversations with our clients in our advanced tax strategy program this time of year, and we say, hey, we do a lot of video calls and say, hey, that television behind you, this is actually TV behind me. So I brought this TV up from the house. It's a 75-inch Sony TV, and I put it up behind me at the office. Well, I bought that personally. So if it's going to be here at the office, I need to sell that to the business. And then guess what I get to do? I get to take a tax deduction for that item. In fact, that plant behind me was in my first house way back in the day, back in 2004. And I brought all these plants into the office because I sold the house. Well, I never expense them. I need to expense them. Now, I don't want to expense them for the same value that it was back in '04, unless it's worth that today. You have to, do a fair market value analysis. But the point is, you might have expenses that are lingering around you. You may be sitting in them that need to be a business expense. And now's the time before the end of the year, before 12/31, you generate a bill of sale. You can then sell that to the business. There's a set of steps that are involved. Again, talk to an accountant to go through those steps specifically, but you just want to make sure that you're documenting the sale of the item and that there's money moving. So you say, well, Nate, my business doesn't have any cash in it. Well, you can loan the company the cash and then pay yourself the expense of the item. Okay. So then it just becomes a bill on the company as a liability, and then you've expensed it. Now, I might be going into the weeds in terms of how you do this, because some of this might just be like, oh man, I just need a professional to do this for me or do this with me. That's always not a bad idea. But I wanted to be on your radar at the end of the year. Start doing inventory. Okay. So that's your home office. And keep that written out for you. Another thing we've discussed briefly, and I want to go into a little bit more depth on today, is what people have heard about called the Augusta rule. You may or may not have heard about this, but it's the code section 280 in the IRS code. That's what us tax geeks call it. But the Augusta rule is really simply renting your home out for up to 14 days tax-free. So there's a rule that if you rent your home or a portion of your home for 14 days or less in one calendar year, and then in the calendar year, then you are not required to claim the amount that you rented it for as income. That's pretty nice, isn't it? It's a great tax strategy, especially if you are having meetings, if you're having company events in your home. So say, for example, you were to go out and rent a meeting space or an event space for the same type of event. What would you pay? So running a fair market analysis, you say, well, Nate, I would pay like $1,000 a day if I was going to rent a space out for an event. Okay, maybe you had a team building event or continuing education or something like that, or you had a meeting with some of your team members. Some folks have folks coming over, staff members coming over, and this is you've designated as a meeting space. Some people have an annual event and they invite their teams over, whatever it might look like. Well, if you were to then have that expense out, then naturally you should be considering that the company would pay you for the usage of your home for that same type of activity if you are using your private residence for that particular event or company workshop. So then what happens? Well, then you simply pay the payment and you document it, bill with a bill of an invoice, an agreement. And so the company, well, let's just use an example, $1,000. So you had, say you had 14, I'm just going to throw this number out. That's just because it's on the PowerPoint. Say you actually did it 14 times in a year. Okay. Of course, that's the maximum. Think about that. And it's $1,000. I don't know what the number is. You'd have to run comparables and get fair market analysis. We do this for our clients in our program. What's the number? Well, if it's truly $1,000, it's 14 times. You've just saved $14,000 in taxable income. So that means that that's $14,000 less of total income that you have to report as taxable. That could be quite a large savings, especially if you're, depending on your tax bracket, you could be in a 20% bracket, 22% bracket, a 24, you can be in a 32% bracket. Some of our clients are in 37 to 40% brackets. So if you figure, I mean, at the top bracket, 40%, what's the math on that? 40% of $14,000, that's $5,600 in savings just from that. Now, of course, every tax bracket's going to vary. It's something definitely to keep on your radar. In fact, you may want to do an inventory since it's close to the end of the year. Hey, did I do that at all this year? Where did I have a company event or a meeting at my home? And have I documented that? And I could still, it's quite possible you can still take advantage of that and write a check today or write a check by the end of the year for those cumulative rental fees for the year. So again, great tax strategy. A lot of people have heard about it, but they haven't really understood the mechanics of it and how it works. So definitely something to keep on the radar. Talk to a pro about that. Another thing that we talk about, and you may have heard about, is hiring the family. And we talked about it briefly at our first round of this. I'm going to go a little deeper today. What does that mean? It means that we pay a family member, a spouse, children for legitimate work, by the way. It's not just paying them because we can. We pay them for legitimate work, and we shift. We shift the income to a lower tax bracket. Now, especially if it's for kids, there's some cases where we pay a spouse. Maybe there's reasons for that. There's other reasons for maybe for Social Security and Medicare. If it's a spouse that stay at home and there's no other income and they're legitimately working, we want to make sure that they're paying in Social Security and Medicare for benefits later. That's a conversation, obviously, with the Social Security Administration Department and see where they're at trending wise for benefits for their lifetime benefits. It works great with kids because if a child is under the age of 18 and there's a family management involved here of a business activity. And so, there's over almost $16,000 that a child can make in earned income. Unearned income has different parameters, but earned income, and this is what we're talking about, legitimate work is earned income, before any taxes are levied, before they get into the 12% bracket. So they're in a 0% bracket. What does that mean? That means that you can, if your tax bracket is, say, I don't know, 25%, right? All in, federal and state. Well, and you pay your child $15,000 for the year for legitimate work. Well, that's 25% that you've saved on taxes because that is taxes. That's money that you don't have to pay in taxes on your own income. That means that's $3,750 in taxes that you've just eliminated altogether by paying your child for legitimate work. What does legitimate work look like? Could be anything. Could be social media. Could be administrative. Could be janitorial. Could be advertising. Could be any number of things that you're paying them for. By the way, there's another benefit to doing this, and that's really helping our kids to build financial literacy understanding why we do these things because we want to be a good steward of what we're entrusted with. We don't want to just be money squanderers. We want to be smart and wise about how we're utilizing this money. Plus, we want to put them to work. And it's good to put our kids to work. It teaches them resilience, teaches them investment, teaches them not to be feeling as though they're entitled, right? We want them to be a part of the process, teach them about entrepreneurship. There's all kinds of benefits to this strategy. Even if it costs us a little time, it's so worth it. I have my own family. I've brought my son into a lot of things we've been doing over the years, and it's helped him to understand entrepreneurship, business ownership, and it's also great for, again, tax savings when you pay a legitimate wage. A lot of factors in this. Again, this is an hour to an hour and a half of conversation in terms of how this works, but I just wanted to be on your radar because if there's work that they've done so far, then you may already have some legitimate wages for the year. Hey, whether they're washing the company car, we'll talk a little about cars sooner than later here today. That's a legitimate activity, right? So you pay them, whatever the going rate is, anywhere from minimum wage to $20, $30 an hour, depending on the proficiency level, their ability, and what the market rate is for a wage for that. Okay. So make sure you're taking advantage of that for your kids. There's a lot of different ways to do this as well. If you have an S Corp, if you have an LLC, there's nuances and caveats with how you must record this. But even if you say, for example, you have a sole proprietorship or a single member LLC, you don't even have to generate a W-2 for the kids. So you don't have to do a lot of paperwork with this other than the agreement. And then, of course, we like to keep a work log on what the type of work is, explain how it's performed, a brief description of the job, and then a log of the hours. All right. Moving on, a lot of people ask about vehicles. We now know that this year for 2025, we've got something called bonus depreciation back to 100%. And people have been asking about that. They want to know, go deeper and share, what does this mean? Well, if you have until the end of the year, you can buy a vehicle. And if it's over 6,000 pounds, whether it's a pickup truck and a lot of SUVs, you can deduct up to 100% of that business use of that vehicle. What does that mean? So say you bought an $80,000 vehicle that qualified, and you bought it by 12/31 and you used it 100% for the business. Well, guess what? There's a good possibility, and I say good possibility because there's thresholds and limitations and things like that that we need to be fleshed out with your individual situation. But it's a good possibility that you'll be able to deduct that full $80,000. So this could be the difference between owing the IRS and getting money back from the IRS. Now, keep in mind, depreciation is a tax deferment. It's not a true tax savings. In other words, eventually, if you go to sell the vehicle, say you sell a vehicle for $40,000 and you've got $80,000 in depreciation. Well, that other $40,000 you either have to pay back unless you do a trade-in and you build the number back up. So keep in mind depreciation. It's just consider it like this. Consider it that it's borrowing money from the government tax-free or interest-free, I should say. So that maybe that tax savings for you is $20,000 or $30,000. Okay, now I've got $30,000 of the government's money that I don't have to pay any interest on, and I can use that perhaps in my business or whatnot until I go to sell the vehicle, and then of course I just pay back the difference in depreciation. So that's one factor there. Here's another factor. It may be the difference between a higher bracket and a lower bracket. It might be the difference between being phased out from different types of credits. For example, the child tax credit, the earned income tax credit, the QBI, the qualified business income credit. That's actually a big one because you may be in what we call a specialized service business, like us, accounting, and you may be capped with your QBI, with your qualified business deduction of up to 20%. But this 80,000 might bring you below the cap. And if you're below the cap, you may go from $0 in QBI to 20, 30, 40, 50, and more. So the difference could be substantial. And so this is an area that you definitely want to make sure you visit and address. That's only if you need the vehicles, of course. Don't just buy something just because it's tax savings. But if you're in the market, have a conversation with an accountant about your specific situation before year end so that you can take advantage of it. Keep in mind, this is very important. You want to get as close to 100% business use as possible, if not 100%. Now you say, Nate, oh man, I use the vehicle for some personal. I can't get around that. Okay, well, here's a thought. What if you purchased a vehicle the last 10 days of the year, right? The end of December. Now you've got maybe dealers are trying to, get vehicles out the door because they want to close them out for the year end. So you might be getting some bonuses there. And you pick that vehicle up on the 27th of December and you only drive it to the office for 3 days and use it business only for the last 3 days of the year. And then guess what happens? You use it for 100% business use. It doesn't matter how many miles are on it for depreciation. You could drive it 10 miles for depreciation. And as long as it's 100% business use, you may qualify for the full 100% deduction of that vehicle. Does that make sense? So don't think I have to drive it, all year long. It could be the last few days of the year. It could be the last day of the year. It's great. So understand that. Keep that on your radar if you're in the market for that. If it's under 6,000 pounds, you can still get a deduction. There's a maximum depreciation of $20,200, which is still great. So if you want to go out and buy a $20,000 vehicle or $25,000 vehicle, you may qualify even for that smaller deduction, which is still a very healthy deduction. Now, when you do take depreciation, you take actual expenses moving forward. You don't take mileage anymore. So if you're high on miles, you may want to consider doing an analysis on that because the miles may end up outweighing the actual in the long run. All right. Next, when we're talking about savings, one thing a lot of business owners say is, I don't have any money to save. Well, maybe you don't, maybe you do. And if you are in a place where your savings are even minimal, you want to consider different types of pre-tax savings as a business owner. So there's different kinds of things, and I want to just kind of list them out so that you can have a conversation again with your accountant. There's a SEP IRA, there's a solo 401k, there's a defined benefit plan. Now, if you're even thinking about contributing and getting some dollars out of your post-tax into your pre-tax, in other words, hey, Nate, I'm having a great year. I might have 5 or 10 grand to put away, and that I want to do it pre-tax so that I can get even more tax deductions. Well, don't wait until January to set up these accounts. You want to set up your solo 401k right away. It takes a while. It takes 30 to 60 days generally to get these set up for the year end. The SEP ones are a little quicker. Now, the beauty of it is, even if it's set up, you don't have to put any money into it, and you don't have to put any money. This is what's really cool about these. You don't have to put any money into them until the tax deadline of the following year to count for this year. In other words, you'll have all the way up until April 15th of 2026 to fund a 2025 SEP or solo IRA. Now, some of them also, if you get an extension, you can go all the way up to the extension deadline, which is October 15th, to fund it for the current year. And then part of the reason for that is because the maximum amount you can contribute is also based on your total income. And sometimes you won't know your income until you do your taxes, right? What your taxable income that is for the business. So that's important. And there's some pretty strong deductions for that. So again, they're all just different levers to pull in the area of savings. So here's the part of the beauty of this is the tax savings are compounded. They grow and your wealth builds. and you are paying your future self instead of the IRS. And that's important, right? Pay your future self instead of the IRS. Here's another thing. Some of these you can actually have a a loan if you need against some of these monies. If you're in a jam, some banks and financial institutions will create lines of credit against these accounts. So what does that mean? That means that, man, if I need to access 10, 20, $30,000, there's a possibility, depending on the bank, that you could borrow against them instead of cashing them out and paying heavy fines and penalties. So those are all really important to think about as you get ready to finish the line across for tax savings. All right, number 7. We're almost there. 10 total. Education, meals, travel. Hey, friends, this is the time. If you haven't done it yet, make sure that you've done your training conferences, seminars. All of the travel for 100% business travel is deductible. Even if there's a personal activity in that, you can still deduct the business portion of that travel. So you say, Nate, I've done all my stuff for the year. The year's almost over. Okay, well, let's talk about 2026. Get your calendar out and see where you might be going anyway on vacation. You see Paris behind me? Hey, you might say, I'm going to go to Paris in 2026. Well, maybe there's a business conference. It doesn't have to be in your direct field, but you may have a conference that, or some kind of a seminar or training. It's ordinary, necessary, and reasonable for your profession, and you attend that. Now, guess what? There's tax deductions for the travel. There's tax deductions for the meals. There's tax deductions for the lodging during that event. So even if you say, well, I'm going to do a 3-day event in Paris or wherever, maybe it's here in the United States, maybe it's in another state, maybe it's down in Florida or wherever, and then I'm going to do 4 or 5 days of personal. Well, we're still going to deduct the business portion of that. Okay. So be sure to get savvy about where you go and try to find some kind of business activity in it. Now, if you're in real estate, you're going to look at a property and you say, oh, I looked at some properties in Florida. Well, unfortunately, that's not deductible directly until you actually purchase those properties. But as far as training seminars and conferences and workshops, those are generally deductible. So keep that in mind. Your meals, the 100% deduction is gone, but we still have the 50%. So keep track. If you have a meal with a coworker, you have a meal with a potential client or a client, you have a meal with your spouse, and your spouse works with you, of course, under that last tax savings strategy. Document it. Document who you're with and what the topic was on the back of the receipt. Take a picture of it, and that way you have some documentation. So you want to document who, where, and why on these tax deductions. Okay, and then travel, of course, as we already discussed. So now's the time to not only try to finish it strong with that, but plan it out for the remainder of the year. A lot of people ask about charitable contributions, like are they deductible, giving through our business, and so on and so forth. And I did want to touch on that because a lot of people have they mistake sometimes think, oh wow, if I just had a conversation with yesterday, if I give to a qualified charitable organization, that's what they're called, generally a 501c3 or other types of qualified charitable organizations, does that directly reduce my income tax? And the answer is sometimes. So the reason for that is, say you're a sole proprietor, say you're an LLC, say you have an S corp, and through the business, or even through as an individual, we're going to use the business, you were generous. So say I gave $5,000 to a qualified charitable organization, Big Brothers Big Sisters or Samaritan's Purse or something, by the end of the year. Now, some people think, oh my goodness, I get to take that $5,000 right off my business income. And that's not how it works. It only works like that with a C corporation, but an S corporation, an LLC, that then is what we call a pass through or a flow through to you as an individual. What does that mean? Then it shows up on what we call Schedule A. So it's your itemized deduction schedule. Many of you have probably heard of it or used Schedule A. And unless the total amount of your itemized deductions exceeds your total amount of automatic deduction, there's no deduction. Okay, so it's whichever's higher, auto deduction or itemized deductions. And many people have a pretty high threshold for their standard deduction, we call it. So it might be, for some people it's, 15,000, sometimes it's 20 or $30,000 if you're over $30,000. If you're a married couple, well, you may not get to the threshold based on your total expenses. So be sure to understand that. I'm not saying to not ever give, but I'm saying be sure to understand so you know how to leverage that. You can also use what's called a donor advised fund. A lot of people don't know what these are, but this is a great tool for you for a number of reasons. Say, for example, you don't know who to give to, but you want to use it. So your accountant says, hey, look, you're over the standard deduction with all of your itemized. The more you give, the better it is for you. Say, well, I don't know who I want to give to. Open a donor advised funds, a DAF as we call them, and you can put money directly into that before the year end. You get the same deduction as if you were giving it to a charity, but you don't have to decide who that charity is. You can do it next year. And the reason is it's kind of tough sometimes, especially at the end of the year, the holidays, so much going on. And I know with me and my family, I've been scrambling at the end of December, like, oh my goodness, we got to make sure we write these checks or be a part of this contribution campaign for this charity. And it takes a lot of that pressure off. So talk to a financial advisor about a donor advised fund. You wouldn't talk to a tax accountant about this. You'd talk to a financial advisor about this. And that will possibly help you, as well as appreciated securities. Say, for example, you have something that has appreciated, whether it's a stock or some kind of an asset. You want to donate it to the donor advised fund. Again, increases all that. And maybe there's a year where you want to do that in a larger amount and take advantage of it. So you may do a higher amount this year just to get over the standard deduction, and you may not do anything for 2 or 3 more years because you've done a lump sum, or you might want to hold it all until you have a higher amount until you get over that amount. So great ways to leverage all of this. And then, again, these are just tax strategies. These are things to put on your radar so that you can have better understanding. And then what you're going to do is you're going to transform tax into purpose. You're going to have profitability with generosity. And that, my friend, is a wonderful place to be. Next. All right, here we are. Record keeping. Who loves to keep records, right? Some of us are like to keep everything, and maybe some of you are hoarders with records. Some of you are like, oh, forget it. I hope I never get audited because I wouldn't know where to find half the stuff. Well, we want you to keep good records. We want you to separate your bank accounts and your cards for business and personal use. We don't want you to, we would call commingle funds. We don't want you to pierce the corporate veil and potentially run a risk if you do have an LLC or an S corporation. So keep all those separate. Plus, it's just good. It's just good accounting. We want you to use software if you can, or hire someone to categorize all of your bookkeeping. We don't want you to miss things, because oftentimes if we don't do that, we're going to miss some expenses. If we miss expenses, guess what happens? We end up not being able to deduct it. So the reason is because if we can track it, we can make sure that it's deducted if it is deductible. And then don't wait for the whole year to go by. Every single month, take a little time and make sure that you are reviewing your books, review your income, review your expenses, review your margins. I know we're all busy as business owners. I know a lot of us are running hard, family, work, life, barely have even time to sleep. I totally get that. And I know I've lived in that space too. However, we have to be disciplined and know our numbers, because if we don't know our numbers, we're going to be flying blind and running our business, and we're just not good stewards at that point. So sometimes we got to say no to some other things so that we can review those books. And then lastly, as you could tell, taxes are complicated, like I opened this conversation. And so don't go it alone. Whether it's us or anyone who you want to work with, make sure you work with somebody who can help you proactively, help you write that tax story before your taxes are filed. We know we save clients money all the time by implementing strategies, and we don't want you to just try to build wealth just by trying to earn more. We want you to build wealth by keeping more of what you earn. And then lastly, I've got a treat for you as well. So I've written my first book, and I wanted to share it with you on business. And so there it is right there. It's called Radical Purpose. I wanted to share that with you. Thank you very much. And it's about my dissertation. So I have a PhD in leadership, entrepreneurial leadership, and it's about Milton Hershey, Walt Disney, and Steve Jobs. And that was my dissertation work that I did. And I studied how they became prolific entrepreneurs, how they succeeded in business and their vision. And I've got 3 books coming out on that topic, on purpose, on the products we have, and on the people who we get to walk alongside of as we lead. So this is the first installment, the first edition, Radical Purpose. It launches December 3rd, 2025. And I would love for you to be a part of that. It would bless me. So all you have to do is go to radicalpurposebook.com. I'll put it in the chat here, radicalpurposebook.com. And then you then simply get on the list. And I will be so blessed to share that day with you. What you do is you just go to the website, sign up, and on that day, we want everyone to get their book on that day because that helps us with Amazon publishing to get higher ranking so that people know who we are and how to find us. So it'd be blessed me, and I know you'll benefit from it. It's not just about their lives, it's about our lives as business owners, as leaders, and how it's a guidebook on how to walk with radical purpose in our life and in our business. And that's what I got today. Thank you so much. And Yolanda will come back on here and close us out.
I'm super excited about the book. Oh my goodness, I can't wait. I'm going to radicalpurposebook.com.
That's
Woo,
right.
woo.
That's right.
How
That's
did
right.
it feel? Holding that book in your
I know,
hand.
right? Feels good. Feels good. And I made it so that it's not super long either. This is about 120 pages, and literally it's a guidebook. It's there for you to walk through their lives. I share a little bit of my story, the hustle story, the growing up in the hood story, mom barely being able to feed me story, and just making so many mistakes in business. And then I invite you to share in your story on how you can live with radical purpose as well.
Well, thank you, Nate, for sharing all that good information. And I will be going to that website when we're done here. Have an awesome day. This was amazing. All this information. Oh my goodness. Every time I listen, wait a minute, we got comments. Let's see. Oh,
Okay. Andrew,
Andrew
thank you.
said he's going to.
Come on.
So
Thank you,
when is
family.
the book release, or all that information is on at Purpose?
Yeah, just go to radicalpurposebook.com. It's December 3rd, but it's gonna alert you. It's
Okay.
gonna let you know, hey, today's the day. It's gonna let you know today's the day. Let's do it together.
Well, congratulations again. I'm
Thank you.
so proud of you and all your work. I know you're excited about it as well.
Thank you. Thank you. Oh, I
Oh,
got you, Ann.
Ian.
Signed copy.
Oh
You
my
know
God,
that.
son too. Yes,
I
and
got
I
you.
agree.
All
I
you
need
gotta
a
do is
sign.
ask. I got you. In
Well,
fact,
we'll
I'll
just go to the event when he has we'll get our books, and then we'll take him to his event, and he can sign it for us in the line with everybody else. How about that?
there
It's
we go.
Andrew's birthday is
Oh,
we're not
okay.
getting to you. You gotta buy it. You gotta buy it. You can get the signature for your birthday.
I got something special for you, Andrew. I got a birthday present with the book. How about that?
Awesome. See,
Mhm.
there you go, Andrew. All right. I don't want to keep you any longer. Thank you, Nate. This has been wonderful. Have an awesome,
Thank you,
wonderful
friends.
day. Be blessed. And we'll talk to you all next Wednesday. We'll meet you in the same space, in the same place on our next webinar.
You know
Bye
it.
bye.
Bye.
Good, I guess.